Hello everyone and welcome back to the SnowOnly Plus YouTube channel. This video is probably on LinkedIn as well, so if you're tuning in on there, thank you very much for watching. My name is Jake Roscoe. Here at SnowOnly Plus, we help clients navigate the complexities of buying ski properties abroad, mainly France, but also Italy, Switzerland, Austria, other countries like Japan and the US and Canada as well. We help clients with all kinds of budgets, so if you've got we've got clients with budgets of 250,000 euros up until multiple millions, 3, 5, even 10 million. So yeah, depending if you've got whatever budget you've got, you can reach out to us. We'd be more than happy to help. On my channel, I like to bring on experts who will help you along your buying journey. And today I'm joined by Mike Winstanley from Bentley Reid. Hi, Mike. How are you?
Hi, Jake. All good. Pleasure to be here and hope you're well.
Yeah, all good my side. I've just come back from skiing myself. So as you can see, I forgot to take my sun cream with me. So I am a little bit red because it was sunny on the mountains. So rookie error from my side. So yeah, would you like to give me a quick introduction on yourself? And again, I know you've been on the channel before, but just a little recap on who you are, what you do, and then I've got a few questions to ask you.
Yeah, sure. So Mike Winstanley, Bentley Reid, what we do is we're a wealth manager both in the UK and also internationally. We provide a full range of wealth management services, including investment management, tax efficient investment advice, and also what we're probably going to spend the entirety of this call talking about, life insurance and the relevance of it.
Perfect. Amazing. So that goes into the first question. Why, the first question that a lot of clients ask me is when I speak about your services, why should they buy life insurance?
Great question. Okay, so there are actually a couple of different reasons why people who are purchasing a ski chalet would want to buy life insurance. We're actually only going to focus on one, but just for completeness, there's if you've got a mortgage, you might want to get life insurance to cover that mortgage in case you pass away, and that life insurance would basically pay the debt off. A more simple one is just family or liquidity planning. Like, if you were to pass away and you maybe have young children, it's just leaving a pot of money that's available to them. But today we're actually just going to talk about one very specific thing, which is UK inheritance tax liability. So if you buy life insurance, you're effectively buying life insurance to cover a potential UK inheritance tax liability. What you're not doing is getting rid of the liability. So if your liability was £100,000, all you're doing is buying £100,000 worth of cover to cover that liability. Really important to note, and I think we've talked about this in previous shows, but inheritance tax in the UK is on your worldwide assets. So that includes your ski properties, basically. And just practically, when you pass away, and I know this is very morbid, but we're talking about life insurance, so I might as well. When you pass away, your inheritance tax bill, it needs to be paid at the end of the 6th month after you had passed away, for then, I guess, probate to be achieved and your estate effectively to be unlocked and then money to be paid out. So effectively, your beneficiaries have to pay the tax before they receive the money. So a lot of the time there's an issue with that. There's a timing issue. Like, a lot of your beneficiaries don't have that money in their bank account to pay the tax. So normally, if they don't have life cover, they normally have to get something like a loan, and that can have a lot of costs associated with it. So why do you need life insurance? Today, we're just talking about it to cover an inheritance tax liability, not to get rid of one.
Makes sense. And super relevant at the moment as well. I was speaking to a client not long ago, and he was in France skiing for 2 weeks over the holidays. He said there wasn't a drop of snow for 2 weeks, and it was super icy and super dangerous. And he was like, I've never seen so many helicopters, rescuing people off the mountains. So yeah, not an ideal way to, especially for 2 weeks as well, right? It doesn't usually happen. Usually it snows over Christmas time. So definitely relevant. And also my old boss as well, where I used to work, she had a similar situation. She had to, her mother passed away, and she had a property in the UK. And I know obviously we're talking about overseas property, but she had to get a bridging loan to pay for the inheritance tax, which is kind of what you just touched on there, isn't it? Because they need to pay.
Yeah, definitely. I think like when I've spoken to people who've been introduced through SnowOnly, it's probably the one big kind of, not even misconception, because people don't even have like a conception in the first place. It's just, oh gosh, is this a thing? What do I do? And obviously, like, that's how that conversation really normally starts, is here is the practical reality of what happens when you pass away, and if you've done very well in life, basically.
Yeah, for sure. And it's like you said, it can be overlooked, right? You don't even know that you have a liability sometimes.
Yeah.
So it's important. It's important to look into these things. Moving on. So how much cover is actually required, would you say? And is it fixed, or is it likely to change?
Oh, is it fixed or likely to change? Well, let's say at the moment, right? So we're talking about inheritance tax cover. So at the moment, inheritance tax in the UK is charged at 40% of your overall estate value, less some reliefs, which are known as the nil rate band. And we can maybe touch on what these reliefs are in another episode. I think what would be just really relevant to say to people at the moment is, if you're watching this video and you're thinking about buying a ski property, and this is in fact true of everyone that we've spoken to, you've done very well in life to afford to buy these ski properties. Everyone I have spoken to, you've got a liability right now. So you have an inheritance tax liability, even after some reliefs. So those reliefs, for a lot of you, they're not stopping inheritance tax. They might reduce it a little bit, but they're not stopping it. So if you're asking how much cover is required, if you're considering buying a ski property, then you should think of it like 40% of the value of that property is potentially going to be subject to inheritance tax. And I'm making it super simple for people. If you're buying a property that's worth £500,000, assume there's a £200,000 liability on that property. So assume that cover of £200,000 would be enough to cover that liability. Now, the second bit is it fixed or is it likely to change? Well, number one, from a legislative perspective, inheritance tax ain't going anywhere. Like, they ain't going to get rid of it at the moment. Who knows in the next parliament if that happens? But I think the government right now is making all the signals that tax is only going to go one way. But that means that the cover might need to go up. So if you're buying a ski property, I'm pretty sure everyone on this call was kind of hoping that the value of their property might go up in value over time. So what you can do, you don't have to do this at all, is you can actually have a policy that increases the amount that's insured annually, either by inflation or just a fixed amount. Obviously, the premiums will also go up. The amount you pay will also go up. So you can have a fixed amount throughout, or it can increase with the value of the property or the value of inflation, say.
Nice. That makes sense. Makes complete sense. So, and what kind of, policies or would be appropriate, and why?
It is a big question, isn't it? So there's two things people should know. Number one, you can buy a policy, say, on your own life, which is called a sole life policy. So I just buy a policy on my life. If I pass away during that the term of that policy, and we'll come into that later on, then it will pay out on my death. You can also buy a policy jointly. So that's either, so say with a spouse, and it can pay out either on the first death or the second death. The type of policy that's right for you depends on your living situation, if you're married, and also what your will say. A lot of the time, what we see is that someone might buy a ski property, say, on their own in their own name, but their will says that all of their assets go to their wife. So effectively, when they pass away, the wife inherits everything. There's no inheritance tax on the first death in that situation. The tax is only paid on the second death. So what we normally see people do is they get a joint life second death policy in those circumstances. So that's in terms of what type of policy, sole or joint. The next thing is, I guess, effectively the duration of the policy. Mm-hmm. So again, we're trying to cover an inheritance tax liability. You should only buy a policy for the duration that your liability is going to exist. So you're a husband and wife, you have a property, you have no intention of ever selling that property. You should probably get whole of life insurance. So that insurance will pay out on the second of you to pass away. Okay, that's a really super simple way of looking at it. Let's say you own this property though, and at some point in the future, you plan to gift that property out, to get rid of that property outside of your estate. You could buy a 10-year term policy, You could buy a 20-year term policy. You could buy a 15-year term policy. So you buy a term policy when you think at some point in the future that liability is going to go away. Why is it really important? The term or the policy that you get directly corresponds to the price you pay. So the longer the term, i.e. whole of life or a long term, the higher the chances that you're going to die in that term, which means the higher the cost you're going to have to pay. So it's really important to match the liability to the duration it exists.
Makes sense. And also, like you said, everyone's case is different, right? So it's never going to be a one size fits all, is it? Okay, cool. So how would you say policy is, structured? This is probably the question that I get the most, and I think you do as well, especially from our clients, is how is it structured so it sits outside of the estate, basically?
Yeah. And I always say this, it's almost like a caveat, which is if you get life insurance, it always has to be written in trust, which basically means that you set the policy up, you pay the premiums, you're the person who is insured, but the proceeds, when you pass away, the proceeds are paid to a trust, and that trust is outside of your estate. Okay, so that when the money is paid out, it does not increase your estate value, i.e. increasing the tax you pay. If you don't set a trust up, and to be honest with you, like we have seen some people who haven't done this immediately and we have to chase and chase and chase, then there is a fallback that yes, if you don't set the trust up, the policy could pay out into your estate and effectively increase the value of your estate. A trust form can be totally free. It is just simply a piece of paper. Most life insurance companies have their own versions of the form that you simply need to complete and submit once that policy has gone live. It doesn't cost you a pound or a penny to do. You just submit that trust form, and then it guarantees that those funds do not pay out into your estate. So that's number one, is how do you structure it, I guess, from a trust and legal perspective. But I guess the next part of that is that people ask is, okay, so I've got the trust. Now assume I die. What happens? Because that's the second thing that's the second most common question I get, is what actually happens in practice. Where it sits outside your estate, you don't need probate for this policy to pay out. Once a death certificate is provided to the life insurance company, they usually pay out within a couple of weeks. In fact, we've seen it sometimes within sort of 5 to 10 days that they'll pay they'll pay the proceeds out, to the trust. And then the trust, the executors of your estate, beneficiaries, can then use that payout to pay the inheritance tax bill, which then opens up the estate to achieve probate and then actually distribute funds to the beneficiaries. So you can kind of see, if we go from the beginning all the way to the end, how that life insurance policy, you buy the policy, whatever term you need to suit your needs and your situation, and then you put it into trust, and then obviously you're paying your premiums if it pays out on your, if you pass away during the term, it then pays out into a trust, and then your executors can use that to pay the bill. So that's a sort of start to finish approach, I guess.
Yeah, nice. That's a great explanation there, of the process of how it works from start to finish. So thanks for clarifying that. What kind of costs are we looking at, Mike? Would you say? I know obviously there's a lot of different options, right? But tell us a bit about costs.
Yeah, sure. Okay. Whistle stop tour, so I don't bore anyone silly on this. Number one, it depends on whether or not you've set the premiums that you're paying to be guaranteed or reviewable. So guaranteed is normally more expensive, but what it means is that the price you pay at the start is basically the price you're going to pay all the way throughout. Mm-hmm. Whereas reviewable starts lower, but then each year likely it increases with inflation, some actuarial changes as well, but likely that premium each year goes up. And sometimes that reviewable premium, a lot of the time, it can increase far beyond the guaranteed premiums. Yeah. Although reviewable premiums look cheaper initially, we actually love the idea of guaranteed premiums, because what you're doing is you're basically replacing this potential future liability and you're replacing it with a known monthly cost, which is, I think, for most people that we talk to, when they actually think about it, it's just the peace of mind. Like, that's why you're buying the life insurance policy, really. It's the peace of mind that when you passed away, like, this is something that pays out and it's all sorted. If you've got young children or even like sort of kids in their 20s, like, you're leaving them with quite a big thing to worry about. Whereas you've got this guaranteed cost, you're paying it, you're sorting it out, it goes into a trust, your executors, would use those funds to pay the inheritance tax bill afterwards. It's kind of I guess you use it for peace of mind, basically. So assume you're going for guaranteed premiums, you have to do a medical, and your overall health can have an impact on the cost. Again, that's an episode in itself. So I think the less said about that, the better, but medical does play a part in that one. So let's give you just a couple of assumptions or a couple of examples. So we talked before, you've got a couple, they've got a house. Let's say they've got a £1 million liability. They are a couple, they're 60 years old, they've got no health concerns, so the medical hasn't changed anything. And they're buying a joint life second death policy. That's going to cost them 10 to 12 grand a year, every year for the rest of their life. So that's going to be around 1 to 1.2% a year of the amount of insured, and you pay that every year. And if that's guaranteed, it's fixed throughout. But again, let's go back to it now and think, you've got the same 60-year-old couple, they're looking for another £1 million on that joint life second death basis, but they don't think that a liability is always going to be there. They're hoping that after, say, 20 years, they do some planning, and that liability, they either gift the property or they simply spend the money. That liability drops out of their estate after 20 years. Instead, they could buy, say, a 20-year term policy. Now, a 20-year term policy, that costs around £3,000 to £3,500 a year. So that's around 0.3% a year. Compare that to the whole of life, 1 to 1.2% a year. That's why I said at the start, like, really need to match the liability to the duration in which it exists, because that's a material cost saving. That's you're thinking like between £7,000 and £9,000 a year you'd be saving over that 20-year period, which is huge, really. Imagine what else you could be doing with that money if you're confident that you're going to be able to get that liability outside of your estate, and you have that liability to begin with. Looking at it, for a lot of people, sometimes they have even a shorter term time frame, say a 10-year time frame where they've got this liability. Premiums are even lower because, again, whole of life, it's guaranteed to pay out at some stage it's kind of guaranteed to pay out on your death. 20-year, that's a wide time frame. You get a 60-year-old couple, it could pay out at any point until you turn 80. For a 60-year-old getting a 10-year term, you're basically only covered until that person's 70. So it's only a 10-year window. As a result, the premiums are even cheaper. So premiums are around £1,400 a year. So that's 0.14%. So again, compare that right at the start versus the 1%. You've had a material cost reduction versus the whole of life and even versus the 20-year term. So it's really, really important. When we go all the way through it, hopefully I've kind of like highlighted to people all the way through. It's about joining everything up. I hear so many stories about people going, let's just buy a whole of life policy. Yes, a whole of life policy will cover you for the rest of your life. It's guaranteed, but you will pay the premiums for it. And if you don't need it covered for the whole entirety of your life, you are throwing money away there. So really, really important to know what you're buying when you go into it. And I think it's probably everything.
Oh, sorry, I interrupted you there. Yeah, super insightful. And again, like you said, like just speaking to you and really understanding, people's needs and not having to overpay for things, I think is a really important part of the process. But until they speak to you and they understand their liability and how long they've got it for, they might be, like you said, in other cases, be paying for something that they don't really need, right?
Absolutely. Yeah, couldn't agree more.
For sure. Okay, and the likelihood is a lot of the clients that are listening to this and on this call, they're in a similar situation to this, with around that sort of age group with the children as well. So it's super relevant for everyone. Okay, we'll wrap it up there. Thanks very much, Mike. Really appreciate it. I'll do all my YouTube jazz, which is like and subscribe to the channel if you want to carry on seeing content like this. We've also got a 5-step guide to buying a ski property, which you can download. There'll be a link in the bio below. We also have a Discord channel, which basically gives you access to information before everybody else. So I'll link that below as well. That's popping off at the moment, which is really nice. And yeah, just again, if you've listened this far in, really appreciate you watching the content, and hope it's been relevant to you. We'll give you some time back. Don't want to take too much than 20 minutes of your time. Mike, as always, thank you very much for joining us and giving us your expert insight. It's really useful and invaluable to the client. So really appreciate it.
My pleasure. Thanks so much. Cheers.
No worries. And I look forward to the next one.
Yep, same.
All right, mate. Take care.
You too. Cheers.
Bye.